Your debt-to-income ratio is an important consideration when buying a co-op apartment in New York City. This is because most co-ops have debt-to-income ratio requirements, which are stricter than what banks are looking for. This means that you won't necessarily qualify for a co-op apartment even if a bank is willing to give you a mortgage. Most co-ops in New York City require a debt-to-income ratio of 25% to 30%. However, the specific requirements can vary by building. In some cases, co-ops do not even specify their targeted debt-to-income ratio for applicants. Many co-ops also have different interpretations for what is considered income when computing the debt-to-income ratio. So, what is the debt-to-income ratio? DTI demonstrates what percentage of your monthly income goes towards your fixed housing expenses, such as your mortgage and co-op maintenance payment. The debt-to-income ratio and post-closing liquidity are the two main financial requirements imposed by co-ops on applicants. Let's say you make $15,000 a month. If your debt-to-income ratio is 25%, it means that you spend 25% of your monthly salary on housing expenses. This means that the total amount of money you spend on your monthly mortgage and co-op maintenance, plus special assessments, is 25% of $15,000, which is $3,750. If you have other fixed debt payments such as student loans, another mortgage, or a car payment, co-ops may also ask you to include these when computing your debt-to-income ratio. How do co-ops calculate the debt-to-income ratio? A typical co-op calculates your debt-to-income ratio by dividing your monthly income by the sum of your monthly liability payments. What's interesting about co-ops is that each one has its own particular rules about how to calculate DTI. For example, many co-ops exclude passive income for the purposes of computing your monthly income. Other co-ops will have rules for how you calculate the monthly mortgage payment used when computing the DTI. What is the average debt-to-income ratio for co-ops in New York City? The most common debt-to-income ratio for co-op apartments in New York City is between 25% to 30%. It's also fairly common to encounter co-ops which allow the debt-to-income ratio to be in the low 30% area, such as 31% or 32%. Co-ops often take a holistic approach to evaluating a buyer's financials. This means that many buildings do not specify an exact requirement for debt-to-income ratio. If the co-op you're considering does not have stated financial requirements, it's a good idea to leverage the expertise of a seasoned buyer's broker in order to help assess whether you'd qualify financially for the building. Where can I find a co-op's DTI requirements? If a co-op has financial requirements for applicants, they will usually be stated on the co-op's purchase application. Your buyer's broker will usually request the board package from the listing agent for review early on in the process. If the listing agent is unprepared and is not familiar with the co-op's financial requirements, your buyer's agent can reach out directly to the building's managing agent in order to learn about the financial requirements maintained by the co-op board. Quick tip: you can save money on your co-op purchase in New York City and reduce your buyer closing costs by requesting a Houseit Buyer Closing Credit. We've helped buyers in New York City save millions of dollars in closing costs since we opened our doors in 2014, and we'd love to help you too. To request a Houseit Buyer Closing Credit, visit www.houseit.com.